All right, well, let's continue to talk about these retail earnings that are picking up. Stocks potentially waiting for this next big catalyst. We are right at record highs, though. You got the S&P above 5,300. Dow 40,000 watch continues. We want to bring in Bhanu Baweja. He is a UBS Investment Bank Chief Strategist. Bhanu, it's great to see you here. So I'm curious, how are you looking at these current valuation levels and what it means for potential upside from here?
Look, I think the potential upside in equities is reasonably limited because valuations are quite high, which is remarkable given where interest rates are. We just have to bear in mind that interest rates are not the entire discount rate. The discount rate is the risk-free rate plus risk premium. And if the risk-free rate is high, at this minute, actually, risk premia are extremely tight. You can look at credit spreads, and credit spreads are actually approaching the tightest. And that's one of the reasons why valuations are as high as they are. We find it quite difficult to see further upside in valuations. What is true is that companies still have very high margins. You were speaking about consumer companies. Although discretionary companies are not giving great results, as you guys were discussing on the program, some of the staples companies are giving you some really good results. And even within Walmart, there has been sort of greater supply or greater revenues coming from staples. So the earnings picture still is reasonably robust, and we think it will remain so for the coming quarter or so. But beyond that, we think the US economy will slow down. I think already when you look at where the retail sales numbers are, when you look at the control group for retail sales, compared to where the numbers were in the second half of last year, so Q3 and Q4 of last year, you're beginning to see sort of a palpable slowdown. And we think that this will begin to sort of permeate into company earnings also. And we think that by Q3, these numbers would be looking a little bit weaker. And so there is upside. We're looking for the market to go towards 5,400, but not much more beyond that. And if I was to look at bonds relative to equities over the next 12 months, I would firmly favor bonds.
Bhanu, how much weakness? Can you drill down a little bit more just in terms of what we should be expecting with that pullback?
So if you're thinking about where the S&P goes to, so from 5,400, you could actually see the market going sub 5,000 before it rises again, because we do need, I think, a reality check in terms of earnings expectations for next year and year after next. The market effectively is pricing in Goldilocks. The market is effectively pricing in very strong earnings growth, very strong revenue growth with very low inflation. So inflation expectations have gone up when you look at things like University of Michigan survey. But when you look at the actual inflation break-evens in the fixed income market, those numbers are still quite low. So the market's pricing in very strong growth with very low inflation. And that's a combination. We've had that through 2023. I don't think it's likely to persist. And I feel quite strongly that while inflation will come lower, it's growth that is likely to surprise to the downside.
Well, Bhanu, let's look global here for a second. Looking across equities in China and Europe and the U.S., particularly with the NASDAQ, there is a winner here, right? And it's driven by tech. I know you're not long the Mag 7 right now. Do you think it's time to short U.S. equities and go long on the FTSE?
We do prefer global equities relative to U.S. equities. But again, let me say this as clearly as I possibly can. That's within the context of being not very ambitious with equity returns over the next 12 months. We think sort of mediocre returns over the next 12 months. And in most places, China is an exception, Japan is an exception, but in most places we prefer bonds to equities. It's only in China and Japan where we actually prefer equities to bonds, where valuations are at a much lower level. And we spoke about Magnificent Seven and tech. We've liked tech for a long time. We're not chasing Magnificent Seven at these levels. We do think that while tech does make sense globally, there are many other markets where we'd be long tech, including in China, where we've been long internet for some time and we would be long internet. That's a tactical trade. That's not a trade I want to hold on to for the next 5 years, but I think it does make a lot of sense over the next 3 to 6 months. Similarly in Japan, so Korea, Taiwan, these are places. So APAC is where we are buying tech. US is where we had bought tech and are not chasing it anymore.